Hello and welcome to this video on the topic of MA and Ema. MA, or moving average, is a commonly used technical analysis indicator in the field of finance. It is used to determine the trend of a financial instrument by smoothing out its price action. Moving averages are calculated by taking the average of a certain number of data points, such as daily or weekly closing prices. The data points used to calculate the moving average can be adjusted to suit different time frames and investment strategies. For example, a short-term moving average, such as a 10-day moving average, is more sensitive to short-term price changes and can help traders identify short-term trends. On the other hand, a long-term moving average, such as a 200-day moving average, is less sensitive to short-term price changes and can help traders identify long-term trends. EMA, or Exponential Moving Average, is a variation of the moving average indicator that gives more weight to the recent price data. This means that the EMA responds more quickly to recent price changes than the traditional moving average. EMA is calculated using a formula that considers both the current price and the previous period's moving average. In conclusion, moving averages are a widely used technical analysis tool in finance, used to determine the trend of a financial instrument. EMA, or Exponential Moving Average, is a variation of the moving average that gives more weight to recent price data, making it more responsive to recent price changes. Thank you for watching, and I hope this video was helpful in clarifying the difference between MA and EMA.